Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Sharmila. Let's welcome our experts then. Sangeet, Lakkar of Newberry Capital, independent advisors Vivek, Mavani and Sharmila, Joshi join me on the show. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss what's causing the underperformance in Kotak Mahindra Bank compared to the other private sector banks. Arvind itself has also been down in trade. What's causing the underperformance there? Since the move that we've seen in Reliance, Nippon and Reliance Capital is saying that they want to sell and asked Nippon to buy out their stake, which is a better bet now, HDFC, AMC or Reliance Nippon. And we also look at Aavas Financers, which has been rallying significantly in trade. What's the view there? So those are the topics that we'll discuss on Hot Money today. Let's start with the first one, and that is Kotak Mahindra Bank. Has not been outperforming some of the other banking stocks. Again, on Friday, there was this big block tail in which ING sold its stake in the company, and the counter was down another 3% in trade. So what's the view on Kotak Mahindra Bank? What's causing the underperformance as compared to some of the other corporate facing banks or retail facing banks like like your ICICIs and the Axis Bank? What's the view on Kotak Bank? That's something that we'll ask. So Vivek, I'll start with you. Kotak hasn't done well. It's pretty much stayed at this level, or it's been sliding lower. It hasn't managed to recover what some of the other banks have done. What, according to you, is causing this bit of underperformance in Kotak?
Well, I would just like to have a different opinion on this as you are what is causing the underperformance. Well, if we look at the shorter term, last 1 month, 3 months, 6 months, the shorter horizon, yes, Kotak Bank has underperformed the likes of Axis Bank or an ICICI Bank or even a Yes Bank. But if we look at a 1 or 2 year or even a longer scenario, Kotak and HDFC Bank have probably delivered most consistent and highest performance among most banks, private or PSUs put together. Not only consistent, but a much more stable performance in their stock prices. Now, if we are coming back to the underperformance, well, Axis and ICICI had underperformed for almost 3 to 4 years, since 2015 to almost late 2018. I mean, they had seriously underperformed for various issues of their own in terms of earnings growth, balance sheet issues, governance issues, management issues, and whole lot of things. Yes Bank also much of 2018 faced similar issues, and Yes Bank had almost a 40% price correction in 2018 itself, and post the supposedly clean chit, I'm using the highlighting that supposedly, one is still not sure, clean chit by the RBI on their quality of the balance sheet. Yes Bank has also rallied almost 30% from the lower levels. So in that light, Kotak looks like an underperformer, but let's not deny the credit that over a 2, 3 or 5 year or any time period that we look at, actually Kotak Mahindra Bank has been much better performer, much more consistent performer in terms of the stock price as well as the underlying earnings, without any controversies on the management governance issues or issues on the quality of the balance sheet. Notwithstanding the price correction that has happened, partly because of the block deal that happened on Friday, I would be a buyer in Kotak Bank on declines, and I would continue to accumulate at lower levels. A disclaimer, me as well as on behalf of my clients, we already have an investment in Kotak Bank.
Okay, that's the view that's coming in. Buy at these levels and at lower levels. Sharmila, would that also be the strategy that you would follow? Would you buy Kotak, or you believe that this underperformance probably will continue?
I think it will, because I think that one of the reasons why we are seeing the underperformance is that it's pretty much in line with what happened with private banks or retail facing banks, as you call them, in 2018. One after the other, we saw them getting involved in some issue, whether it was Axis Bank, followed by ICICI Bank, followed by Yes Bank, and I think even Kotak Bank, that whole issue with the promoter holding having to be bought down has definitely cast sort of a shadow. Otherwise, this was one of the most expensive in terms of valuation banks till then. I mean, as Vivek was saying, there was really no reason why anybody wouldn't have recommended a Kotak Bank till then. But we have seen the stock getting range bound because that whole issue about that issuing of preferential shares to themselves and trying to circumvent the problem in that manner. I think that has not gone down too well. Secondly, I think, for the longest time you thought that they will come up with something by 31st December because that was the date given to them, so that you would know that how they intend to really do this, whether they're getting another investor in, at what price that investor comes in, who that investor is. So, they didn't come up with anything till then, and so far we don't have any clarity on that. What we've only seen is one group really exiting whatever stake they had in the bank, which to my mind is not such a big negative. But at the same time, it doesn't answer the main question that, how are they actually planning to do this? And what are the restrictions on the bank in the interim? Because they haven't complied with RBI. I think, that is also still not clear. So I would really wait till I got clarity on both. Otherwise, in terms of anything, in terms of other parameters, there's nothing to complain. And that's an absolute go. But as I said, it was always an expensive bank, so I think just wait for a while.
Okay, Sangeet, what's your view? Do you believe that this is underperformance and this probably will continue, or you think a bounce back is possible?
Obviously, it's an underperformance, but I don't think it will continue. So there are a couple of points. So one is, yes, obviously there has been an overhang about the promoters' dilution. But we'll have to understand two things. One is the promoter, even at this elevated valuation, is not willing to let go of its stake. That gives me a lot of comfort. Even the Friday's block deal which happened, I think about 3 or 4% of equity was sold, and it was absorbed by the market immediately. I mean, the price correction was hardly 3%, and the stake dilution to be done by the promoters is just about 10%. Obviously, it's a large chunk, but that shows that there are buyers available if the promoter is willing to dilute stake. Now let's talk about the business. I think it's one of the better run franchise along with HDFC. It's been grouped under that category. Liability is funded very well with CASA, more than about 50%. The business is growing about 20-23% consistently. And valuations, even despite the underperformance, looks a little rich, but I think quality comes at a price, and investors should stay invested. And I think I'll go with Vivek that you can accumulate at lower levels.
My only thing is they took RBI to court. A lot of investors that got spooked because of that. When you are going against regulator, is that a concern that you would have?
So I don't think so, because I'm sure they would have done their diligence before taking that step, and they would be well advised by their legal advisors or whoever their advisors are, that they are initiating such a step against the regulator. And we haven't heard anything from the regulator there since. This issue is I think they approached court somewhere in mid-December. It's already more than 2.5 months. They haven't heard anything from the regulator, which to my mind would be, I mean, they would have a little stronger case to their merit. So I wouldn't be much concerned about that.
Okay, before moving on, Vivek, since you also would are saying that you'd like the bank and recommend accumulate, are you concerned about this? Because the move that they came out, they thought they will get away with issuing preference shares, but RBI struck them down. So I think RBI is hell bent on getting the promoter to reduce their stake. These guys are trying to. So it's a mess at this point of time. No one knows which way this will go. So is that a concern that you have?
See, as far as the concern, well, I would agree with what Sangeet mentioned, that before going to the court, I'm sure it would have been a well thought out in terms of what plan of action subsequently. I mean, it's like it's a bullet that you fire that you can't take it back. So I mean, it's a serious action that they have taken of fighting it out with RBI in the court. Now that the matter is in the courts, I would just like to add to what Sangeet mentioned. We haven't heard from RBI in the last 2 months. Well, the matter is in the court, and if I remember correctly, it's scheduled for hearing sometime in March. So obviously, while the matter is sub judice, both parties are going to just lie low and keep quiet about it. Now let the court decide in that sense, one way or the other. Now, whichever way it goes, I'm sure Kotak will comply by that. So if court also forces them or gives a judgment that they also need to dilute or sell the promoter stake, I'm sure they will do it. Okay. And I'm sure they would have got a backup plan on that as well.
Okay. So that's the view that's coming in on Kotak Mahindra Bank. Two of our guests believe that it's the right time to accumulate and should be bought on dip. Sharmila does believe that probably the underperformance may continue. The next one is interesting because at one point of time everyone spoke about that whichever forum, and we've had this discussion before, that HDFC AMC always, despite being a better, despite having much richer valuation, always was a better pick than Reliance Nippon. Now, Reliance Nippon has managed to rally significantly, and the reason is that Reliance Capital wants to exit. They want Nippon to buy out their stake. So, you know, the big ADAG overhang that probably would be there on Reliance Nippon probably will go, and that's why the counter did manage to rally over 30% in the past 2 trading sessions. So right now, which is a better pick, because HDFC AMC is also in the last 6 months corrected 30%. So valuations have also been down by 30%. Which is a better pick now, considering the scenarios that we are in? Sharmila, which is a better pick now? Valuation, growth, management, whatever you take it. Between
so
the
I
two.
would say HDFC AMC.
Okay.
You know, yes, I think I agree with your point that since their listing, HDFC AMC has corrected a lot. But I think there was a lot of crazy exuberance at the time they listed also. So, you know, there was a little unreal feel to, you know, what price people were quoting, etc. But I think, you know, now that the stock has corrected, as you said, you know, for all the reasons that you mentioned, their brand value, their management quality, everything, for me, that would definitely be the preferred play. Also, we don't know how this Reliance Nippon thing is ultimately going to play out, what price, etc. So I think, you know, that is it. That stock reacted well on that news because it had already corrected so much on the back of all the troubles and woes of the whole ADAG group. Reliance Capital had also corrected. I think the sort of comfort with this whole thing is that because this is an AMC business, it's a very well-regulated business. So that way, that comfort is there with both the stocks, but I would still prefer an HDFC AMC.
HDFC AMC. Sangeet, what about you? What's your view? Which one would be a better pick, or you would avoid both?
I think I'll go with Reliance Nippon, but it's not a screaming buy as such. But just if I have to choose between the two, I would go with Reliance Nippon purely on account of valuation. So I think Reliance Nippon trades at about 4.5 times the AUM, vis-a-vis an HDFC which trades at about 9 times. 9%, I'm sorry, 9% of the AUM. And last week the news flows which were coming was Nippon was keen to buy out Reliance's stake. Now, if that would have happened, that would have triggered an open offer for the minority shareholders. Now, today's news flow, what I have been gathering from media sources is there are 2-3 private equity players who are in the frame for this. Now, if that happens, then obviously, assuming if 2-3 of them combine together to acquire this, then that doesn't trigger a minority open offer for the shareholders. But in terms of business, I think it's obviously because of the AMC's performance mimic the market's performance, and also the SEBI regulations which came down very heavily on the fees part. It's not an exciting space to be in, but if I have to choose between the two, I think I'll choose a better valued stock, I would say.
Okay, so Reliance Nippon is it. What about you, Vivek? What do you make of this space?
Well, I'll put it this way. Let me break it up into short, medium and long term, slightly more elaborate on that. Shorter term, Reliance Nippon certainly is a serious discount to HDFC AMC. A very well regulated business, so for all the hanky-panky that you may talk about ADAG group, in the mutual fund business it's unlikely to be. That's number one. It's a very clean business, very transparent business. So the sheer valuation gap of 14 times earnings for Reliance Nippon versus close to 30 times for HDFC AMC. I mean, at the valuation gap at some point of time in the near term, the shorter term itself will get bridged. That's number one. Number two is a medium term as to whether it's Nippon Life which acquires the ADAG stake, whether there is an open offer, whether private equity funds, group of or anybody else acquires it. That's a medium term. It's not going to play out tomorrow, day after or any time. And because it's a regulated business, I mean, regulators also need to approve that, and that's certainly not going to happen anytime less than 3 to 6 months. So there remains a question mark in terms of what happens in the medium term. Longer term, I'm actually not excited about the AMC business itself. I mean, the whole business of money management in the form that exists today. SEBI is determined to bring down the total expense ratios which directly hit their revenues, and there is a same hit on profit. So longer term, yes, all of us are bullish about financial services space in terms of financialization of savings and savings moving to more organized way of getting managed as far as especially the retail money and so on and so forth. So I would not be surprised that the total AUM of this country grows or rather doubles every 5 to 6 years. So what we are talking of is a growth rate of 12 to 15% growth in AUM across all. I mean, I'm talking total AUM. The composition between equity, debt, liquid funds, ETFs, all that. Let's not get into that detail. But the total AUM will double probably every 5-6 years, but the revenues and profits of the AMCs may not double in the same period, because the realization on AUM across categories will be on a secular decline mandated by SEBI. That's for certain to happen. ETFs, where the revenues and or realizations on AUM are very thin, ETFs are also gaining a larger share of the total AUM.
Okay.
So in that light, when we are talking of slowing revenues, slowing profit, margins compressing over a longer term period, over 3 to 5 years, at 30 times HDFC AMC certainly is not a screaming buy. Yes, it's certainly a great franchise, a management that deserves a premium, but there are better opportunities available. I mean, rather than buy any of the AMC stocks.
Okay, that's the view that's coming in on the asset management company. We move on to Arvind, and Arvind has been under serious trouble. It's trading at a 52-week low. There seems to be a lot of traction, at least in some of the companies, at least in the textile space. So what's causing the underperformance in Arvind? That's something that we'll ask. Sangeet, I'll start with you. What's causing the underperformance there?
So I think the valuations, if I see, are in line with the other peers. Maybe it was overvalued earlier, you could say. So it trades at, I mean, the debts are at elevated level. It's about 3,100 crores. The last quarter results which came out did not look exciting at all. The revenue was muted. Moreover, they have even lowered the guidance, which is actually caused a serious stock correction. And textile traditionally has been a very difficult business. I mean, it's a very capital-intensive business. Again, even at the current elevated debt, the promoter has outlined, the company has outlined a capex plan of 500 crores in the next year, another 400 in the FY20. So that debt will continue to stay at elevated level, and it trades at about 5 times EV/EBITDA. Which is more or less in line with the sector peers. So I don't see a case where I would say Arvind is an underperformer or buy at this level.
Okay, what about you, Vivek? Arvind, what's your view?
I would agree with Sangeet. I'm not a great fan of commodity textile business of Arvind. I mean, so that's what remains in Arvind now. I mean, it's basically largely denim, which is a commodity, and a textile business. Low margins, high working capital, high capex, low return on equity, return on capital, and probably no or negative cash flows or free cash flows. I mean, there are no free cash flows actually. The attractiveness in Arvind was until a couple of months ago, just prior to the demerger, where they demerged the branded garments business, Arvind Fashions. So what we have now at 75 rupees a stock that is trading ex demerger. The garments business, likely to be listed in the next few weeks. Now the attraction in Arvind was actually only that business, and that business is now out of this Arvind Limited, the parent company. The branded garments business, I mean, I like that sector, but one needs to see what the performance of Arvind's branded business is like. But for for commodity textile business in Arvind at 75 rupees, latest quarter numbers had a 23% decline in profit after tax on a continuing business or like-to-like business. This year there was, the branded garments business wasn't there, last year it was there, but you adjust for the pure textile business, 23% decline in earnings on flat revenues and increasing debt, and no visibility in terms of how the margins ever will improve or how the return on capital ever will improve. The return on capital, by the way, return on capital and return on equity, by the way, over the last many years in the textile business for Arvind has not even been 10%. I'm not really a great fan of such kind of companies which struggle to even generate double-digit return on capital and return on equity or even free cash flows, and they have no leverage to improve the business dynamics. So I would just avoid it.
Okay, what about you, Sharmila? Would you also avoid? What's your view on Arvind?
Yes, I think so. I think obviously the sort of preferred play was the branded apparel, and that was obviously giving the entire company a better valuation, because all said and done, that's where the fancy of the market has been on this whole consumption play, and that branded apparel and the kind of brands that they had under that umbrella fit that sort of in some thinking over there. But when you're looking at just the textile business, and again, to just repeat, it's a commodity business. They've gone through the entire sector has gone through a lot of pain over these last 4 or 5 years. I do remember a time when all these textile stocks used to be very fancied plays, and they were all trading at fairly fancy valuations as compared to now. But you know, in this last 7-8 years, things have been pretty much downhill for textiles. Plus, I think even recently there have been concerns, whether it is to do with rupee, whether it is to do with raw material prices. So I think sector concerns are there, and I think those are now playing out on their results, etc. So I don't really see a scenario where it will sort of come back into fancy. So I think you should wait for the branded business to get listed, and if at all, take a call on that.
Okay, so that seems to be the call that's coming in on Arvind. I think the play was on the branded business. Even if you're looking at it, some of the other denim stocks, you know, be it an RV Denims or a Nandan Denim, all of them are under pressure. So denim, textile, pure play textiles as a play is not doing well as of late. And the last stock we want to talk about is Aavas Financers, which is at a 52-week high. When most of the other NBFCs are not doing well, this counter has managed to move up above the 1,000 level. Vivek, I'll start with you. Aavas Financers, what's your view?
Well, I'm neutral on it purely because I would, as a matter of habit, would want to see stocks go through an entire up and a down cycle, go through how they manage challenges and so on and so forth. In that sense, Aavas Financers is slightly early in its own life cycle of growth, etc. But for what I understand about Aavas, it's part of the AU Financiers Group, AU Small Finance Bank, I mean, which is now, since they've got the bank license also. They're part of that same group. They have all the building blocks in place for a sustained growth in affordable housing segment. They are more like regional plays because they don't have a pan-India presence. I think Rajasthan itself is like almost 40-45% of their business, which is their home state. But besides Rajasthan, I mean, they are into neighboring states, Gujarat, Haryana, Punjab, parts of Madhya Pradesh, and of course growing, and claim to have all the infrastructure in place, technology for better credit assessment, etc. But I would still like to see that in action. They've been in business for now almost 5 years, but return on capital, return on equity is still hovering just at about 10 to 12%. Management's view is that they are under leveraged. I mean, it's a leverage which will ensure much faster growth going forward. But then leverage is always a double-edged sword. So growing the book, loan book at an aggressive pace, keeping return on equity high and keeping non-performing assets low, I would like to see the entire cycle play out and then evaluate whether I will get into Aavas. From a valuation point of view, they are close to 5 times price to book, and which is where I have nothing against it. But as I said, paying 5 times price to book for a 10-12% return on equity company, which probably over even 3 years later will only go to about 13-14, or on the optimistic side 15% return on equity 3 years down the line, I would much be happy to pay 3.5 times price to book for a Kotak bank with a 20% return on equity and a track record of 20 years.
Okay.
So I mean, it's just a preference between one or the other. Nothing against Aavas. I would just like to see much longer track record in Aavas before I may take a call on it.
Okay, Sharmila, expensive Aavas?
Well, actually, more than expensive, I really don't know enough. I've just seen the numbers. The numbers look decent. And I think, you know, on the negative side, you're talking of affordable housing. You're sort of focused on one state. Affordable housing in itself has not really taken off in quite the way it was expected. So yes, you need to sort of get little more in terms of numbers and how they perform in a cycle. So as of now, I'd just stay neutral.
Okay, what about you, Sangeet?
I am positive on this stock. I have been always positive since the listing. So they have a very unique business model. So they only have direct sourcing for their clients, and that's why you see the NIMs to be very high. The NIMs are upwards of 9%. And they lend to also very select category of borrowers, which is self-employment based and less than 10 lakhs ticket size. And as Vivek mentioned, they have the technology in place, they have the distribution model in place, and that's how you see the NPAs to be sub 0.5%. And remember, the balance sheet is growing at 40%, you know, and they are largely equity funded. So there is no asset liability mismatch as such. You know, and valuation at 5 times, they are maybe a little expensive, but I think with the growth which they have demonstrated, I am happy to pay that price.
Okay, that's the view that's coming in on the final stock, Aavas Financers. Sangeet is rather bullish on it, but overall, that's the view that's coming in. But with that, it's a wrap on this edition of today's Hot Money. Many thanks to all of my guests. Vivek, thank you so much for coming in. Sharmila, Sangeet, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg.